Today, the RBA considered 25 and 50. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Well, the RBA released their minutes from the discussion in early February today, and they said that prior to considering the policy decision, members noted that inflation in Australia remained too high and that the incoming data on prices and labour costs had tended to exceed expectations. While a significant part of this was attributable to global factors, strong domestic demand relative to the ability of the economy to meet that demand was also an important contributing factor. Members observed that inflation was likely to have reached its peak in the December quarter, but this could only be confirmed in a few months' time, and trends in inflation in other countries contributed to this expectation. The central forecast was for inflation to decline to within the target range over coming years, but that the pace and extent of decline remained uncertain. Medium-term inflation expectations, though, remained well anchored, and members agreed that it was important that remained the case. The Australian economy grew at a solid pace over the second half of 2022, they said. However, growth had slowed more recently and the outlook was for a further slowing. Growth in consumption, in particular, was expected to be subdued in 2023 as the post-pandemic recovery wanes, higher prices and household interest payments constrain real disposable incomes, and falls in housing prices reduce net wealth. Interest rates on variable rate home loans had risen substantially over preceding months and required mortgage payments that were projected to reach their highest level on record as a share of household disposable income. Nonetheless, members noted that measures indicate the extra savings accumulated in Australia over the preceding 3 years were very large, and there were plausible scenarios in which consumption growth slowed by even more than forecast, as well as scenarios in which it was more resilient. Members observed that unemployment was at its lowest level in nearly 50 years and that the number of job vacancies remained very high, even if somewhat less than in prior months. The Australian economy was benefiting from higher terms of trade and would benefit more than a number of other countries from China's reopening. In the light of those considerations and the policy decisions, members agreed that a further increase in interest rates was warranted. The recent inflation data had suggested more breadth and persistence in inflation than had been expected, and that strong demand was leading to price increases in some parts of the economy. While inflation was expected to decline, there was a risk that it could persist at an uncomfortably high level, which would entail longer-term costs. And members also noted that the cash rate was lower than policy rates in many other comparable economies. While wages growth remained lower here than elsewhere, Australia's positive exposure to higher commodity prices and the extra savings buffers accumulated by households were estimated to be larger than other countries. And there were also notable differences in fiscal policy and population growth around the globe. Members observed that the cash flow channel of monetary policy was stronger in Australia than other countries, given the high level of variable rate debt. But members also observed that, after taking account of all the channels for monetary policy transmission, there was little evidence to suggest that the overall impact of monetary policy on activity and inflation in Australia was materially different than elsewhere. The board considered two options for its policy decision: a 50 basis point increase and a 25 basis point increase. The arguments for a 50 basis point increase stemmed from the concern that there had been a pattern of incoming prices and wages data exceeding expectations and a risk that high inflation would be persistent. If it did persist, there would be significant costs, including higher interest rates and a larger increase in unemployment later on. Relatedly, members observed that the longer inflation stayed high, the greater the risk of price and wages expectations moving higher. The arguments for a 25 basis point increase also recognised the need to bring demand and supply in the economy more into balance, but noted that inflation was expected to have reached its peak, that the outlook was for a softening in consumption growth, and that there were many uncertainties around the outlook. Members observed that while underlying inflation had been higher than previously forecast, headline inflation was below earlier expectations, and the forecast was for inflation to fall within the target range by the end of the forecast period in mid-2025. Many households were facing tighter budgets and, in aggregate, real incomes were falling. There were plausible scenarios in which consumption growth was weaker than expected and inflation fell faster than forecast, as well as scenarios in which the opposite occurred. Members acknowledged that there were arguments in favour of both options, but concluded that the case to increase the cash rate by 25 basis points at the present meeting was the stronger one. So members noted the uncertainty around the outlook and that the monthly meetings provided the board with frequent opportunities to assess how those uncertainties were being resolved and to adjust policy if needed. With interest rates already having been adjusted substantially, there was less need to move by 50 basis points at this meeting. Members noted that the forecast for output inflation had been prepared on the technical assumption that the cash rate reached around 3.75%. Consistent with this, members agreed that further increases in interest rates are likely to be needed over the months ahead to ensure that inflation returns to target and that the current period of high inflation is only temporary. In assessing how much further interest rates might need to increase, the board will continue to evaluate developments in the global economy, trends in household spending and unemployment, the evolution of labour costs and the price-setting behaviour of firms. The board is seeking to return inflation to the 2-3% target range while keeping the economy on an even keel. The path here is a narrow one, and there are risks in both directions. The board remains resolute, though, in its determination to return inflation to target and will do what is necessary to achieve that outcome. So a couple of takeouts here. Nothing new, really, because, of course, Phil Lowe was in front of Parliament last week and said much the same. But it is interesting that they did consider 25 and 50, but not no rate increases. And then the other point is the plural, multiple rate rises ahead. So anyone who thinks that we've reached the peak or that rates are going to drop substantially in the near term are kidding themselves and everybody else, actually. The truth is rates are going to be high for longer. Inflation won't be back within target band until 2025 on the best estimates of the RBA. And as a result of that, you have to expect higher rates for longer with more downdraft relating to how the economy behaves. And that is not good news for either households nor businesses, but is probably more realistic than many people were thinking just a few weeks ago. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.